If you've been trying to learn how to day trade using technical analysis, then you've probably done a Google search or a YouTube video search of candlestick patterns, right? Like there's the wedge pattern, there's the bull flag, there's the bear flag, there's the descending triangle, descending wedge, gap ups, gap downs, and all this stuff can get kind of convoluted. Not to mention if you go deeper and look at candlestick patterns, specifically like the shooting star, the hammer, the hanging man, the bearish engulfing, the piercing line. There's so many different patterns where if you try to use all of these and actually apply them in real time, you're going to see 10 different indicators of like, okay, this is bullish, but wait, because of this pattern, it's bearish, and you end up becoming a scalper. And it's my own kind of theory. This is kind of speculation, but I feel like this is pushed on purpose because brokers and hedge funds want you to be scalpers because then they can make more money off you through commissions. This doesn't really count much anymore because of free commissions, but mainly, ECN fees and just other ways that market makers make money on you. They want you to trade more so they make more money. And also, if you trade more, you're more likely to make more mistakes. And even if you have 6 wins in a row of small green profits, you can make a mistake on one trade and lose it all, give it all back, and then some more. So I'm here to provide a different perspective on trading and how I've been able to trade successfully over the past 6 years using a very simple pattern. And this doesn't have to do with actual, candlestick patterns like the hammer or the hanging man. And this isn't a scalping pattern. So if you want to be a scalper, I don't really know why you would want to do that. But if you do, then this isn't the video for you. But if you want to be able to find perfect entries on stocks and ride them for 100% gains in a single day, stress-free because you know this is how stocks move, then stick around and watch this video because this is going to be amazing insight into how day traders actually can buy stocks and hold them for dollars and dollars and dollars per share. So the very first thing that I want you to do if you're going to try to kind of implement this strategy is first just take off all of your indicators. Trust me, you don't need them. I spent years trying to make them work. And the whole idea of why I used those indicators was because I thought there was like a holy grail combination of indicators that would like be able to predict with certainty a future move. But you have to kind of scrap all that and understand that at the end of the day, trading is random and you're never going to have a 100% win rate. You're never going to have full certainty of a winning trade. So instead of trying to find that certainty, it's better to approach trading from a risk management perspective first. Understand that every trade can fail and accept the risk with every trade. Because once you do that, you stop caring so much about, the small green trades and locking in the green. And it allows you to become more patient for those bigger runners. The best thing I can recommend, if you are trading right now, you should take some time, take a weekend or just some time, look at all your past winning trades using something like tradervoo.com or something like that, and look to see how much further those stocks went after you sold. I can almost guarantee you that on almost every trade, you sold too soon. So the goal is not so much, forcing more trades like that, but learning how to maximize your winners, and not by using indicators or chart patterns like a falling wedge or a double top, but by actually understanding how trends work. And this is what my entire kind of trading system is based around. It's using support and resistance lines that are very easy to follow and very easy to identify once a trend has broken down. So today's example is going to be on AURC. And if you want more examples, I have hundreds of videos all around this same idea of using previous resistance as new support. So the actual setup that we have here, the way that I like to call it is using the pre-market high as new support on a first green day stock. So this is obviously primarily based around small cap trading. It does work sometimes on mid caps, not so much on large caps. It's not really an option trading strategy. I have other videos on that if you want to check those out, but this is mainly for small cap day trading, so penny stocks. And there's 3 main criteria that you need to see for this. Number 1, there needs to be a pre-market high set. In this case, you can see here that there's a pre-market high. And notice I'm not even using the candlestick chart. There's a pre-market high right here, right near $15.16. Second, there needs to be some increased volume. Now, a catalyst is good, like some news, but it's not really needed. And third, the stock needs to significantly break out over that pre-market high after market open. And so I mainly use the 5-minute chart. And you can see here on AURC, it had a significant breakout where in the first 5 minutes, it went from 14 bucks to a high of 16.60 and then even halted, had a volatility halt. And then after that halt, it went up even further to 20 bucks per share. That is a significant move. This was able to move $5 per share or about 34% in only 4 candles. Now, most traders would look at this and be like, okay, well then the goal here obviously is just to buy the breakout, right? But I don't really vibe with that. I don't like buying breakouts so much anymore. I used to. Once again, I've been making videos for a very long time and I've been trading for a very long time. I used to be a breakout buyer, but I've learned, because I've improved and adapted as a trader, that this is not really the best way to manage risk. So here, once we see this stock make this big move, we can now make a trading plan. So the basis of this strategy, like I said, it's using pre-market high as new support. So we know that the entry price we want is going to be that pre-market high level. Once again, that is at about 1520, 1516, whatever. And then for our max loss, now this number is very important. I have a bit of an advanced kind of risk management strategy. I don't just have a simple entry and stop. I do something called selling into break even if the trade breaks down. And once again, watch my other videos for a deeper dive into that. Max loss for me is usually the next support lower. And in this case, it's about 12.50. So yeah, I'm risking, technically $2.5, $3 per share. But my first target for partial profits is up near 20 bucks. So just off this alone, right? Say you were just using a basic target, stop, and entry, you would be risking about 18% to make about 31%. And that is a positive risk reward. Now, because I'm so much of like a systematic data-driven trader, I've developed this tool called the Trade Planner. And basically, say you have an account size, let's say you have $25,000, right? And we know that with that number, you want to max lose 2% per trade if you have a loss, because that's a very manageable loss and it's not going to allow you to blow up. There's actually math done on this where it would take over 200 max loss trades back to back to back to back to lose all that money. And you could be the worst trader in the world. You could be the goldfish from Michael Reeves and do better than that. So the chance of you losing that much is pretty slim. So we know that with any trade, we can lose 500 bucks. So now we can use it. So now we can use the trade planner to actually calculate our trades. So we know entry price is 1520, max loss is 1250, first target is 20. And this actually tells you 2 key things. Number one, it tells you how many shares you can use. So in this case, with a $25,000 account, if we trade 185 shares and we take a max loss at 1250, the most we lose is 500 bucks, which is very controlled. And in order to make 500 bucks at that first partial target at 20 bucks, you have to sell 104 shares. So we would have about 80 shares left over for that bigger move if it does continue. And this is dynamic, right? You could have, say, a $2,000 account. Yeah, you could take a lot less size, but still is a good trade, right? This is dynamically traded to be based around your account size because that's how you can stay stable and not blow up, right? Many traders want to go all in on every trade. And it sounds great, but you're going to blow up if you do that. I've had many people I've worked with in the past who had a week of amazing wins. They think that they've beat the market and they forget about risk management. And then next trade, they take a max loss and they never stop out and they just lose it all. And now they're not with us. So take it slower, right? It's a marathon, not a sprint. You want to make this a career, not a get rich quick idea, okay? So very awesome tool that we have. We have the trade plan now, right? We know that our entry price is 1520. So when you see a setup like this, all you got to do is just send a limit order, limit buy. Don't wait till it gets down there, because if you wait too long, you might get cold feet. You might be afraid of buying the dip. Just take the best entry possible and then see what happens, because you've managed the risk using the trade planner. So if you had sent a limit order like I did on AURC, you can see it pulled back down, halted down, looked very scary, but came back down and it bounced off support perfectly. So then after that bounce happens, you now know, okay, I need to sell X amount of shares at the first target at 20 bucks. Send the limit, sell preemptively. Don't wait for it to get there, because then once again, you might get cold feet. You might want to hold and hope for the bigger move and it could just end in disaster. lock in your partial profits. Trust me. So then you can see this was able to spike up. Boom, already $5 per share. And then once you take that first partial profit, just sit back and wait. See if it's going to break out, because if it does, things can get pretty interesting. You can see here, it held against resistance. It pulled back a little bit. It was fine. As long as support holds, don't do anything. Don't stop out below VWAP. Don't have a trailing stop. Don't worry about it. You've already paid yourself, right? So just wait. Eventually, this was able to get the strength and it broke out. Now, the interesting thing about AURCs was that it was at new all-time highs. Usually with these stocks, I would go to the daily chart and mark off historical levels. But here we had none to go with. So I really just had to kind of wait till the stock topped out. And I know that sounds counterintuitive because you won't be able to hit the exact top. But as I said before, usually if you try to find the top, you're going to sell too soon. So let the top form and then sell into the backside. So you can see it halted up, had a massive spike. Now we're up over, basically 100%. It went to $29 in that first spike. So during this, right, this is where it gets kind of hard for newer traders who are going to try this. You have to ask yourself, okay, where's the previous resistance? It still is down at $20. So technically, this could pull back all the way down to $20 and still be bullish. It could bounce off there. So yeah, you would technically lose, $9 unrealized. And that's why you shouldn't look at your unrealized P&L, because it's just going to cause you to sell too soon, panic sell, all these things, right? You might think that locking in green is good, but in reality, you're getting stopped out because of emotions. So here, my main idea was as long as it holds support, it still is fine. It pulled back a bit, but you can see it bounced off $25 very nicely and broke out over new highs. So now, because we had no levels to kind of go off of, this is where I kind of messed up in this trade, and I'll just be fully transparent. I said, all right, great. We have a new resistance. It needs to hold. This level here near 2890s. As long as it could bounce off that, it's 100% bullish, and we're just chilling to new highs. But then you can see it had a bit of weakness. It tried bouncing and it fell back below. So here I kind of made a rash decision, and I'll kind of go into this more in a sec. But I said, okay, that doesn't look too great. That looks like a failed breakout. I'm going to lock in most of my profits and sell most of my shares back into $29 as resistance. So as it came back up, I had the limit sell and I sold most of it. I didn't sell all of it though, because I was still thinking like, well, technically the support's still down at $20. And as long as it holds above $20, it still is fine. And that's what I should have focused on in the first place, right? I shouldn't have been so concerned about this small price action, because as you can see, this didn't really care about this pattern too much, and it broke out even higher, went to 35, pulled back, went even higher, went near $38. And then around here in the afternoon, we saw one thing that kind of signaled to me that, okay, this is looking a bit weak. Because all this price action was pretty fine during market hours. But then there was one candle right, where was it? It was right here. This kind of big flush. And you can see that it was kind of, holding against resistance. It wasn't really holding this overall trend too well. And once I saw that flush on, I was like, okay, I've held for over $20 per share now. It's time to lock in profits, right? I can see the top has formed here. It's time to exit. So then I sold into the bounce and I exited the rest of the trade. And that was pretty much that. And you can see now AURC has pulled back heavily since then. So if you find good trending stocks, you don't have to buy and sell in minutes or seconds, right? If it's an actual strong trade, you can kind of wait for the trend to form and wait till you see the top and then sell. If you can do that properly, you're going to have bigger winners. And on the flip side, those winners will outweigh the losers. And that's obviously good for growing accounts. Main takeaways, I highly suggest that you go back through your past trades, take the time, make an Excel spreadsheet or whatever, and just see, okay, I sold at X price. How much higher did it go? And you can kind of gain stats. Say that you sell on average for 10%, and on average, your winning trades go actually 40%. Well, now you have data-backed confidence that, hey, on the next trade, maybe I should wait a little bit more. Maybe I should not sell so soon because the data shows me that they go further. Data-backed confidence is the best thing you can get as a trader. It takes work, but most traders don't want to do the work, and that's why most traders fail. All right. So with that being said, that is the strategy that I use every single day. It's a simple one, and you only need one strategy, right? You could see a ton of different kind of patterns or indicators, but all you need is one system, one strategy. If you can focus on one winning trade or one winning strategy, then you will be successful if you just focus on that. With that being said, if you enjoyed this video, be sure to give me a thumbs up for the YouTube algo. I have a free full 1-hour course that you can get by using the link in my bio, which really focuses heavily on data-backed confidence and how to get it. Also, if you want to join my chat room, we have a 14-day free trial. I do webinars every single day, Monday through Friday, in pre-market and after close, talking about my trades. 14-day trial, click the link down below for that. And with all that out of the way, I'll see you in the next video.